What's up, guys?
Good to see you.
Doing well.
We got the second one of the fall coming out here. We got a good guest coming on, but before that, Peter, you want to go through? You have a Calendly tutorial. Should we talk some shop, like how the sausage gets made, how we're scheduled?
Well, how we're struggling to schedule, I think is the better phrasing, right? We find it quite hard to. We're all busy people.
Aligning calendars shouldn't be this hard.
Yeah, I think we should do the next, because this is the age of the MGA on how to build an MGA. I think our follow-up podcast can be on how to schedule podcasts, just 10 episodes straight. What do you think? Riveting stuff.
I think we'll have even fewer viewers than we have on this show.
Yeah, I want to see how low we can get. Like, can we get to zero? Negative number. Dylan, I heard you had a cold shower this morning.
Yeah, pilot light went out. That's rough. That's rough.
Yeah. Is that because, what happened here?
Honestly, I have no idea. Pilot lights should just stay lit unless there's a problem. I think there could be some kind of buildup in the little gas line, so gotta have to figure that out.
Interesting.
Yeah.
Peter, what's the pilot lights? They exist in England? I don't really know what the infrastructure is like. How do you heat things?
The best one I had was when I was living in the small village in Spain, and it was gas. So we had the gas guy would come around Tuesday and Thursday mornings in his truck, beep outside your house, and you just had to take an old one out and replace it. La bombona, they call it, if you needed to replace it. And my boiler was so old that I don't know how old this thing was, but there were months on end, Dylan, where it didn't work. And if those months were during the summer, that was kind of okay because a cold shower is fine, right? It's like really hot outside anyway. But so I had constant battles with that boiler and also the gas delivery and being in for those things. So, yeah.
Yikes.
Do you think whoever? What was that?
What do you mean? What's that?
Did you guys hear? Did you guys?
Me interrupting you? No, I didn't hear one.
Alert?
No.
Oh, okay.
I was just gonna say. So in Guatemala, first time going to a Central American country, ready to take a shower, and there was this electric pack. Like if you look at the shower head, it's attached to the shower head. There's a wire going to the shower head, and you could hear it arcing. That was the most terrifying shower I've ever taken in my life.
Do you think somebody stumbled upon this podcast and they're like, I thought this was an insurance. What the hell are you guys talking about?
Well, that's risk management. We're talking about the potential of gas explosion. We're talking about electrocuting yourself. It's clearly relevant.
True. Yeah. Good homeowners policy. I hope was that.
Yeah. There we go.
It must be a really slow news week that this is how our conversation has gone. There's nothing going on. There's nothing interesting in the insurance world.
Shuts down for the summer. We're still in summer.
There was a big acquisition, as far as I know. If we want to talk any insurance news, which I'm not sure we do on this podcast. Sompo agrees to buy Aspen Insurance in a $3.5 billion deal.
Interesting.
Wow.
I did not see that. Well, there we go. I got a little.
There we go. Headlines.
By the way, when was that announced? I didn't even see that one.
I didn't see that either. Did we break
this
news?
week? This week sometime. Yeah.
Maybe we were. There we go, guys. We talked some insurance. I was so bored last night with trying to find headlines to talk about today that I accidentally got in a battle with some lemonade investors, which Dylan, I think.
I saw that.
Talking about my Kinsale investment and how it is doing slightly better than lemonade, but you don't want to get on the wrong side of those people. They will. I think I got doxxed this morning by one of them.
Oh my! It's suddenly started to rain very heavily here in the UK, so I'm going to have to close my shed before I get flooded. I'll be back.
Well, Peter's in his shed, like office shed, right?
I love that he's just disappeared. This is fantastic.
Yeah. going off the rails here. Wait, he did this once with his dog, right? He just kind of walked off set.
Yeah. You have disappeared? I thought you disappeared once.
Maybe. The podcast is really boring when one of the hosts leaves.
You just need to fly him out of here. The hot water talk was enough for me.
I don't know if you can see, but I actually got soaking wet just doing that.
Yeah, you look good. You got your cold shower.
The perils of recording in an outside shed.
Yeah. I do. You should take some pictures, and I want to see what this looks like. Outright, like how big it is. The outside.
Still talking about the shed here, or
yeah. I love this idea. I hate working from home is awful. So if I could kind of move myself out of the the family unit, I think that would be
and into Peter's shed.
Actually, I'll just
there's space for you, Doug, in here for sure.
It was a long commute. Well, listen, if it's anything like what Dylan and John worked in, which we got to get permission from John to share that photo.
We did during the show.
Yeah, but nobody watches the show. I'm talking about
and by the way, this conversation's why, just so we know.
Yeah.
Anyway, all right.
Let's wrap this up.
Whose guess is it today?
It's mine. I got a guest that reached out to. Oh, sorry, I reached out to him because he was shitting all over VCs as far as MGAs are concerned. I think those were his words. I'm just joking. I'm sure he loves VCs, but talking about the misallocation of capital when it comes to MGAs and having VCs.
I remember. Yeah, that's right.
Topic near and dear to my heart. Actually, we had at Stable, Dylan, we had amazing VCs. We had other investors that knew the insurance space that were not so amazing, which we can talk about another time. But I love, had a quick call with Adam to understand a little bit more about what he'd like to talk about and how they did their raises. And they are a massive MGA, guys. These guys are doing a lot of premium. We'll see if he's willing to share that. It's also a technology play. They didn't start as, if I understand correctly, did not start as an insurance company, as an MGA, right? They had some wearable devices that they thought could be applied to a workers' comp product, and now are killing it, if I understand correctly. So we're gonna have a good conversation on how to correctly raise capital, how they raise capital, pitfalls, things like that. We will, I'm sure, poke fun of some VCs. So maybe we should have one call in and see what they have to say about that. But
get one live on the line. I like it.
Live on the line. See if we can roast them. Yeah, but this is going to be a good one. So let's get him on.
That's great.
All right. Great. All right, Adam. Hey, welcome to the show, man.
Thanks for having me.
Yeah. So listen, I had the pleasure of meeting you a couple weeks ago. We had a nice conversation. Dylan and Peter have not. And so because these two know nothing about what you're working on other than what what maybe they've read, hopefully in advance, let's start there. Because I think you guys don't have the typical MGA path, right? You had a product first and kind of led into the MGA. Is that correct?
That's right. Yeah. So I can, I'll probably tell you a little bit about myself just to start, so you don't get your hopes up on the deep insurance knowledge. I don't come from insurance, so that's probably the first thing to know. So there might be some questions I just say I have no idea what you're talking about, because you guys have gone, I love the podcast and you guys have gone really deep in the subject. And there's definitely episodes that I've listened to where I'm like, I don't know what they're talking about. That doesn't relate to us.
You can tell that I also know very little because I just have a blank stare on my face most of the time when people are giving us deep knowledge.
But I originally was an aerospace engineer in California. And, back in 2014, I moved to New York City and started a logistics software business. And we were fortunate enough, we sold that business to a publicly traded food delivery platform. And I worked there for about a year. And so I joined Kinetic in 2020. And you're exactly right. We didn't do anything in insurance. Kinetic was started by two engineers, Hatham and Aditya. Around the same time I had started my logistics software business. That's actually how I knew them, from the ecosystem. And they had set out to prevent injuries in the frontline workforce. And they had done that through, using technology. And our product back then, our only product back then, was a wearable device that helps prevent strain and sprain injuries in the frontline workforce. It's really a device that, in fact, I've got one here that connects at your waistline, just kind of goes on like a tape measure, and has a bunch of sensors in it that measures your kinematic motion and really picks up on repetitive motion and poor ergonomics. And so what we were doing for the first 5 years of the business was we were directly leasing these devices to very large self-insured customers. So we didn't get involved with their insurance. We went right to their safety teams and said, hey, you're self-insured, you're incurring a lot of costs for these types of injuries. We have a product that will help you directly on those costs. And we did that with, everybody from UPS to Home Depot, just really big organizations around the world. And ultimately what we found was that the product worked great, but there weren't that many large companies ready to drop $1 million a year on top of what they were already doing in an EHS. So the market just wasn't as big as we had hoped. And we'll get into this, I'm sure, but we were a venture capital funded business, and the whole model there is you create nobody wants a $5 million revenue business if they're a venture capitalist. They want a $500 million revenue business. And so we didn't see a path to that. So, around 2021, we had this product that was fairly low cost for us to develop. We had a lot of proven results, and we ultimately said, there's got to be a better way to get this into the market, and there's got to be a bigger market for this because it works. And I'd come from, industries where there was a very large workers' comp premium associated with it, all these last mile delivery businesses. And I started working with Hatham, one of the co-founders, and we really, we were fortunate. Nationwide Mutual was an investor in our business, and from the early days. And so we went to them and we said, hey, we think there's something here in insurance more than directly leasing these devices. And they connected us to their programs division, which is where all of their MGAs are associated with. And we started talking with them. And in 2021, we set up an MGA to be focused on monoline workers' comp in the US. And at that point, the real hook was it's workers' comp, but it's got devices. and that was the differentiator. As we had a tool for prevention, we became very focused on industries where we thought we could help. And we focused on mid-market and larger business. So we weren't really there's a lot of people that started out there, especially in the comp space, with an underwriting advantage. Hey, we've got a lot of data. We're going to quote this stuff really fast. We're going to go direct to consumers and cut out broker fees. We didn't do any of that. We continued to work through retail agents. Our average premium is about 150,000 in size. So these are accounts that have claims and industries that have larger premiums. And that's really how we stood up and got started in the MGA space.
Yeah, that's amazing, Adam. Thanks so much. A lot of questions come to mind for me. And one of them, big picture, is I've seen a lot across a lot of different lines, this mix of hardware and insurance coverage together. And quite a few of them don't work for whatever reason. It sounds like you guys are quite an anomaly in that case, and it sounds like a really successful initiative. So congratulations. But my big question is, how do you see the interconnected relationship between the hardware and the insurance product? Is it that you want that hardware to give you data back on the insurance to make better, profitable underwriting decisions, or you see a real value that differentiates you in terms of gaining the customers from the hardware?
Yeah. Well, I didn't finish the remaining 4 years of the journey, which is we are probably more of a claims management organization with software today than we are a hardware business. So we started with that hardware, and it was unique. It was very memorable, worked really well in terms of going to these brokers that work with these larger risks and having a product that stood out, and something they could take as a risk consultant back to these style businesses. But what we found over time was a couple things. Just like you said, hardware is hard, and there's a lot of failure stories out there for several reasons. Our hardware is essentially, and I think almost in all insurance lines, what you find for the most part is hardware is usually some sort of prevention or analytics tool needed for better underwriting or risk mitigation. And what we found was that even though the device works really well, It's the change management that can kill it. The implementation and usage of the product is really challenging. And we were fortunate. Nationwide has a dividend on file that we tied usage of the product to the dividend. So we had some nice kind of carrots and sticks in the system to say, hey, you got to use this to really qualify for all the goodies that we're offering as an MGA. But we still found that, for us to successfully use the hardware, we had to make a very compelling business case to the broker and employer of recent claims that they had that we could point to and say, this would have been prevented if you went through the headaches of getting everybody to wear this device. This would have been prevented, and your XMOD and comp, the XMOD and the premium would have gone down as a result. And that just became, as we scaled, because we're fairly large MGA now, a diminishing amount of accounts that you could do that on, even though they had the risk exposure. Everybody's got the water leak exposure, but if they haven't had a water leak, it's kind of hard to convince them to use it. It's the same thing with devices. So everybody's got, in the industries we write, everybody has these repetitive motion tasks that are exposed to the types of CT or lower lumbar injuries that we're trying to prevent. But if they haven't had one, them convincing 200 employees to put on a device every day is pretty challenging. And so what we realized within probably a year to a year and a half of starting the business in the MGA side was we are going to have to tackle a broader swath of risk here in a different way. And so what we started doing almost 3 years ago now was fully focusing, again, the benefits of being a VC-backed, early day VC-backed business was we had a big software team, and we could redirect them and say, hey, instead of focusing on this hardware that everybody has claims that we're dealing with, let's put all of our efforts and muscle into managing the claims better through a lot of software applications. And so today I would say, we really use that as a control for loss ratio and losses in our book as much, if not more, than the devices that we see.
And is that pitch successful to brokers? Because they're the ones educating and probably trying to get that sell across the finish line to those policyholders. So it sounds like there's a couple big benefits here, right? I imagine maybe there's some pricing help as well. But is it this is going to be, you have these claims, right? Everybody knows you have these claims. That's probably the one nice thing about workers' comp for what you're doing is there's no policyholder that's not aware of these claims taking place because they happen so frequently. Is it we can almost immediately start helping with those claims by you having this device?
Yeah, I'll tell you this, let me just rephrase that. We can immediately start helping with these claims by managing them better is a much better pitch than we will start helping them with this device. So everybody understands the pain points of claims. Hey, I have no idea what's going on here from a reserving standpoint. What's the resolution strategy? What's happened on this claim? Why aren't you taking action when this employee, has been out of work and I'm pretty sure they have a second job? Everybody understands that. But so if you say, hey, we're going to, use software to do this as if an adjuster was managing just your claim and doing it as well as possible, everybody gets that pitch. Brokers love it. Policyholders love it. Now, conversely, when we first started and said, hey, we have this device that's going to prevent, one injury you've seen out of 60 in the last 3 years, but it was expensive. That flies with some people, but a lot less than the overarching claims management approach.
Sure, and it's probably not as valuable as the essentially the product of handling those claims more efficiently. Because prevention is fantastic. It just depends on the number that you can prevent. Fantastic, but we know we're going to have a ton of claims, and the length of those claims because they're being mismanaged or just the lack of management completely is extremely expensive, and that could be on almost all your claims instead of the one that you prevented. So, so I guess a few questions. One is first of all, just very excited that you want to talk about claims so much. This is great. Sorry, Doug and Peter. So I'm assuming that you're handling your claims internally. So not through a TPA, or is it the system component to it that you're then giving to the TPAs to manage the claims in?
It's a little bit more of the latter. So Nationwide and our capacity partners in general, Nationwide's our biggest, but we have others. They handle the claims. So it's their adjusters. Okay. What we do is we take data out of their claims management system. So in Nationwide's case, it's Guidewire Claim Center. We pull data down on a daily basis of all of their adjuster notes and all of their claims information publicly available. So we don't take private information that gets into a little bit more of the medical record history and details like that, but we pull all the public adjuster notes. So a good example is we can see, if an adjuster hasn't had success reaching out to an employer to get information, or if an adjuster has entered employee has modified duty restrictions, but employer is not accommodating light duty. So we pull all that information down. We read that information across thousands of claims every day. And then we complement the adjuster with automated actions out to the policyholder or our own internal team to basically add horsepower into the management system. And so we're not trying, I don't want to replace the adjusters. Their reserving practices, their reserving philosophies. To be honest, that's pretty nice to leave with a capacity partner because they get much more confidence on their development curves a lot earlier. If you leave it in their own adjusting system versus, putting it in a TPA they've never worked with or, have a lot of questions actuarial on. What we do is we leave it with them from an adjusting standpoint, but we add all these, what we call next best actions in a very highly automated and time-sensitive manner to the claim, which usually those time-sensitive things are things that the adjuster doesn't have to do. It's stuff that we're doing as a policyholder, we're doing as an MGA to help, engage the broker, employer, and employee, or the employer is taking action on those things because we're highlighting the impact of not taking action in a much more real-time basis through text messages, emails, or a dashboard that they can log into.
So do the adjusters that are working on what's the interaction with the adjuster? Are they getting emails? Is this being pushed straight into Guidewire? Is this, how are, when they have to do
it's a little bit of both. It's a little bit of both. We have the ability to push tasks directly into Guidewire. To be honest, I would say that we rely a lot more on just general email communication. So a perfect example is employee goes out, they're injured, on the job, and the first 2 weeks they're completely off work. There's no work restrictions. So there's really no return to work program that you can put in place. We have an AI agent that is listening to those notes coming through the Guidewire system for when the next doctor's visit is. And after that doctor's visit occurs, they're emailing the adjuster to get a copy of the new work restrictions that might be available so that we can get that person in a return to work system. I'd say it's a pretty light interaction with the adjuster. For the most part, it's a lot more interaction with either our internal teams. We have what we call these policyholder success managers, which are essentially account managers on these policies, and the employer themselves.
Okay. Do you ever have any interaction with the employee?
Rarely, but there are certain next best actions. A really good example is missing doctor's visits. So, if an employee misses a doctor's visit, what ends up happening is, let's say they have some set of work restrictions, they're in a return to work program, and their next doctor's visit is going to be, an MMI or something that would take them back into kind of a more full duty expectation, but they missed that doctor's visit. And now what happens is that's 30 days more of some, TTD payments or indemnity payments, et cetera, and delay in their own recovery of, getting better. And so what we will do on the proactive side, and again, it's nothing novel. We're just doing what an adjuster would do if they just had one case, is we're reaching out and reminding both the employee and the employer, hey, you've got this doctor's visit this week. Employer, make sure you're not scheduling this employee during this time because we want them available to go to this doctor's visit. An employee, make sure, you're seeking care for your claim so that you heal and get better as fast as possible.
Was the knowledge you kind of had, like understanding that process, right? Like how, if we had one adjuster focused on one claim, what would be the best way to handle that? Was that knowledge you picked up when you were working with these captives or in working in tandem with like Nationwide? How did you develop that process?
Yeah, I mean, I'd say the primary knowledge comes from, we have our own internal director of claims that we brought on just to start working with Nationwide, right? Big hairy claims. Hey, does this have a nurse case manager on it? Does, do we think Nationwide or, whoever's handling the claim is doing the best they could? And that individual and the team we built out with that individual is really strong from just a claims background and comp perspective. So a lot of this comes from that team saying, here's the best way this could have been done. And then we look at what's the frequency that occurs in, how much does that oversight or not perfect management occur in our system? And then we build software products around that to pick that up with kind of reading through the AI, reading through the notes, recognizing the pattern, having an immediate action to take.
Okay. And this, by the way, is absolute textbook to what I preach all the time, which is that MGAs need to have a claims expert on staff, whether it's a fractional basis, especially if you're just getting started, because you can't afford full-time, claims executive, but getting that in-house and making sure that they're looking out for your numbers, right? Making sure that the claims process is going smoothly, having these conversations, and then really, of course, on your side, it's also helping develop the software component to it, which is certainly another level to this. A lot of people don't go that far ever, no matter how large they get. But having that claims professional or professionals on staff to make sure that those claims are handled, again, whether it's through your capacity provider, your fronted carrier, through your through a TPA, you can't just leave those claims with some other party and then try to be handled appropriately.
and you would, a TPA especially, if you had a TPA, I'd be running for the hills if you didn't have a claims person in-house. Because if you're an MGA, you're the low man on the totem pole at the TPA. You're not getting any attention. You're getting the worst adjusters, you're getting the worst attention. So your loss ratio is going to go berserk at a TPA. If we were fortunate that, when we started, we were just using Nationwide Mutual as our capacity partner, and they had internal claims. So at least they have a little bit more vested interest. But again, you're a program. Typically, if you're an MGA, you're one of, at Nationwide, we're one of 16 comp programs. You're still a low man on the totem pole compared to people they've, had for longer than you. And so when we brought on our first, hire in that space, who's now our director of claims, we watched our claim closure rate go from there's a stepwise jump in our claim closure rate. I mean, it must have gone from 25 to 50 within 2 months, of bringing her on. I mean, it was just remarkable. And now we kind of hover around a very consistent closure rate, more relative to industry norms. But yeah, it would have been horrible without an internal claims individual.
Adam, Dylan, if you didn't know this already, Dylan is a mastermind in claims, real claims nerd. And in fact, the position you're just talking about, the hire you made, that's how Dylan and I really got to know each other. Dylan came on at my MGA as our head of claims. And yeah, I think having that expert in that knows the space well, that's how you can differentiate yourself at an MGA, especially like these high frequency claims MGAs, right? If you're a title insurance,
we have 4,000 claims a year, so and so now, I mean, we have, even though we have a claims team, all of the work our account managers do, which is a whole nother team that services this book and they're assigned to certain accounts, is basically lower level claims management. They're doing it through the system and guidance of that claims individual. But almost everything we do, like I said, is this thesis around, if you could manage a claim with software combined with our individuals, as if a senior adjuster were managing one claim at a time, that's what's going to lead to the best result. That's really kind of how we built our services.
That's
the claims people are the stars of the team. I used to give Dylan the nickname God of Claims and Thunder, just to make sure that he knows that he was well appreciated. I don't know if you have like nicknames for claims people. But you should think about
From an
that.
HR perspective, probably a bad idea to give nicknames, but that's fine.
Yeah.
But ours is Claim Smasher, so it's funny
There you go.
because
there we go.
And she always says I'm just smashing claims, you know.
Yeah.
So,
that sounds more like a Hulk Thor situation with me and your person there.
We'd have a whole Avengers team of claims people coming up here.
I like it. So
Dylan, this is right up your alley. We got right into the claims discussion.
I know, it's so exciting. So exciting.
So Adam, this is great. I love getting the weeds on this stuff, and Dylan appreciates you giving him some claims time. But we actually had you come on. Like the reason we got connected was really to talk more about financing. And so listen, you have an interesting story from a couple of angles, and I think the reason people, hopefully the one or two people that are listening or watching this, are like thinking about building an MGA, right? Maybe there's somebody at a carrier right now or in a claims department, somebody like you, right, who knows a problem well, or maybe has developed some technology and just aren't getting the traction that you want. I think on the device side, there's probably a lot that are out there thinking about that, how they could build insurance products for what they have. So maybe just to talk about the timeline a bit. So you had the device company, right? And that was venture backed. And then did you kind of separate the MGA out as a separate entity, or was that still?
It's a wholly owned subsidiary. So technically, yes, it's a separate entity, but it's all the same investors. So they still, the shares of stock are basically, the combined businesses.
Right. But then the way you funded the capital needs for the MGA were not through venture investors, right? You took a different route.
We did recently, yes. I would say, all this stuff, what do they say? Half success is timing. When we first said, hey, we think there's a better play being an MGA, and that has turned out to be the case by far, because we still run the original business that I mentioned, but we don't put a lot of resources on it, and still have some big customers, Pepsi beverages and some others, but it's a stable, small line of revenue. And by far, our biggest revenue line is and growing revenue line is our MGA. When we first made the transition and said, hey, we're going to make this, first our investors, the VCs, were like, oh, this doesn't sound good. But as keep in mind, this was back in 2021. So, this was the explosion of, Lemonade and Root and Metromile. So when they started kind of looking at the space, they were going, hey, actually this might not be bad. These companies are getting valued at 10 times their premium. And, this is.
Were these VCs though insurance based? Were they investing in insurance? Not really. So these are the existing investors you had for some kind of tech product that is a wearable, and then they went, I'm sorry, you're gonna do insurance now?
Yeah. Right. We were the only insurance, evolving insurance investment in a portfolio that could be hundreds of companies. So these were not specialists in insurance at that time.
Interesting.
And so. But we were fortunate because of, the timing, we got enough capital still on the VC side to kickstart the MGA. And it wasn't a lot. I think we maybe raised 10 million 3 or 4 years ago. And that helped us. And we were very successful as an MGA very early. The first year in business as an MGA, we did 25 million in premium. And, our only capacity partner back then was Nationwide. They thought we were going to do 2. So, we kind of blew the socks off of like what was expected. And so that helped catalyze, okay, we see these other companies and you're doing well, like, we'll put some money into this. And we did bring on, in that round, we brought on one VC that was very specific to insurance, which has been great. This group called Manchester Story, they're actually out of, of all places, Iowa, which is probably where you would expect, an insurance specific VC to be located. And so they joined the board, they invested and led the round. And we grew, we're about 85 million in premium now. and we'll end the year, probably between 90 and 100. And but you're right, we took that round of VC financing back when the timing was right. We were a little bit lucky. But you've seen what's happened in the bloodbath, the last 3 years. And I'd say, we saw a lot of things in the VC community relative to that. First, anybody that wasn't an insurance investor left the space. They were like, unless it's pure software and insurance, like we're not doing any of this MGA stuff. These people have gone for bust, a lot of them, and it's not valued at what we thought it was valued at. These things don't trade at 10 times premium. And so a lot of early stage or, just general VC investors left the insurance space. And the only people left were industry experts that had done insurance investing, I'd say even before the bubble. They really knew insurance. They came from that space. But it was a much smaller group. Usually, I come from VC-backed startups and have been doing that for, 12 years now. And usually, when you're fundraising, you go out to like 200 groups. If you were going out fundraising for insurance right now, there's like 15. There's not a lot, and on the VC side, and so you're and it's a law of numbers, large numbers when you're pitching for the most part in these startups, and that 15 isn't a large number. So good luck. You better have an amazing mousetrap or pedigree. You sold a company for $1 billion or something, and so. Recently, we do need capital, or we needed capital, and we ultimately ended up deciding that the VCs that were still in the space or funding these businesses, I couldn't wrap my head around the math of the valuations, to be honest, of an MGA that some of the fundings I had seen. And because we're getting to a size where we're even talking to bankers about selling the business down the road. And, every banker's like, look, this is an EBITDA play. The buyers are EBITDA based. Here's what you're going to trade out on your EBITDA. And, I was doing the math of, us scaling to 500 million in premium and going, I don't understand how we're going to go raise, 50, on 400 or 300. Like that math doesn't make sense for a VC that's looking for a 5x exit or a 10x exit. And so we really started exploring other options instead of going to the VC community. And what we found was a pretty receptive credit community in the loan markets. And so, we went to kind of the usual players there, Trinity Capital, Triple Point, some of these places that have done a lot more of these big credit agreements. And I will say that one disadvantage is they typically do large credit agreements, 5-10 millions on the very low end. And that's all we really needed. We didn't want to take a huge amount of money because we knew, again, this business trades on EBITDA. Like we shouldn't be trying to blow, spending out of the water. We should be really focused on profitability and EBITDA. But we were fortunate. We got term sheets from, multiple credit partners, and that turned out to be a much better, the dilution is essentially zero. They take some warrants, as part of the, they play in the startup space, so they take some of that stuff. But it turned out to be much more favorable than having to go out to the VC markets. And, even at our scale, I keep in touch with VCs in the space, and we're a pretty good success story, I would say, from like an MGA scaling size and what we've done and the technology and moat we have. And even then, it wasn't a slam dunk. It wasn't like, oh no, here's, 10 VCs coming with term sheets, when I talk about our business. So you could kind of put your toe in the water and see like it was going to be challenging.
Oh, Doug, I think you froze. Oh well. Anyway, so this is
really intense there.
Yeah, he's gone out. He's gone out to write to his 200 VCs for his business now.
Yeah.
Well, I just had to.
Oh no, Doug. Poor Doug.
Make fun of VCs, but actually, I love the Manchester Story crew. They are very good. I think out of the investors that have stayed in the space, they are the educated ones, and they understand the unit economics of an MGA, which is maybe why they're not making as many investments, right? And it has gotten a little bit more difficult. But 2-3 years ago, it was crazy. Like the investors that were rushing into the space, like Adam, at your premium now, at your gross written premium, people valued you at like $2 or $3 billion because they didn't understand that you only kept percentage of that premium.
I mean, I still see rounds though that 800 million valuation on premium our size, and I'm like, man, I don't understand the math. I mean, the only thing that I could understand is if, and I haven't seen these pitches, but if they were saying, hey, we're going to transition to a carrier, that would be one, like, which kind of floors your multiple, but would indicate a little bit more of like the scale you think you could get to. And we're in an industry where we think we could get, $1 billion, $2 billion a premium. But I would say, okay, well, I'll give you that multiple on valuation if I were a VC, and this is probably why I'm not. I'll give you that multiple. When I see you transition the carrier and all the barriers that's going to build, and B, have 5 times the premium. Like it just, I still see some stuff that I just scratch my head of like, where's the math come on this?
So what premium are you at? You've kind of alluded to it a few times, but where are you on gross written premium?
85 million.
Okay. Yeah, that's sizable. Also, the comment you made about, I think it was nationwide, and the 25 million in the first year.
Yeah.
That's really interesting to me. If they're expecting a 2 million, one of the most dangerous things that any kind of insurance underwriting entity, whether it's a carrier or a MGA, MGU, does is grow really, really fast, right? Because so if you have explosive growth, what's the reason? Is it because you're underpricing it, or you're about to blow up a book? What's happened there? What was the reaction when you're, let's say you've doubled it, you're at 5, or is there a point at 10? Where was it where they said, hey, what are you guys doing? Because I feel like that conversation happened.
We, for better or worse, the conversation didn't happen.
Wow.
And I don't want to throw anybody under the bus because I don't think it was a bad thing. That year we've run a fully developed 59, which in comp is great. And so that conversation didn't happen. It happens a lot now, at our scale. I mean, we're double the size of any other program they've got. So we're the biggest player in their whole program business, by far. And I think we're about a quarter of their entire program's book. And so, on comp, they've got a much larger, portfolio of other stuff. But yeah, growth in general, again, a lot of, these startups is luck. And yeah, I think knowing what we know now, we would have been like, wait a second, something's off. This is growing too fast. We spot those things now when we go into an industry, and if we start stacking on premium at way higher, hit rates than we expected, we do a lot of examination to go, wait a second, if there was an industry we went into early this year where we were blowing our growth numbers out of the water for 2 months in it, and our hit rates were like double what we expected. We were putting on, premium left and right in this one industry, and we slammed on the brakes. We said, look, we're not doing anything special compared to somebody else. And there's been a lot of companies burned in this industry. So this is wrong. Like we shouldn't be growing this fast here. And we slammed on the brakes. Now, in the first year, we wouldn't have known that. We didn't have the team or the expertise to realize those types of things. Yeah. So I think, to be honest, it was just a little bit of luck that didn't happen early on.
Dylan,
that's an important lesson. Everyone should hear that and understand that is a real issue. And if you can pour on premium at that point, there's the hard stop method. Certainly evaluate what you're doing, but if there's room, depends on your admitted ENS, depends on what your product is. You should definitely, if you're doubling your expected hit rate, you should be pouring on premium at that point. If you're you've got to do something immediately while you're still evaluating. And the first thing I can think of is make sure you're pumping that premium up significantly, and see what kind of elasticity
from a price standpoint.
Yeah, absolutely. Yeah. Because you're looking at price elasticity at that point. You're saying, all right, what this X rate increase, what's it doing to my hit rate at that point? And
I would say, if you don't understand why you're growing so fast from talking to brokers and talking, then you're growing fast for the wrong reasons. Like, you better have a very clear understanding.
And that might be because someone else blew up their book, right? And you were mentioning that in that industry, right? All of a sudden there's this excess of demand because a book was blown up, and now that's they're searching for a market. So there might be a good reason for it. Maybe you 100%. Are priced appropriately, but there's just a massive surge in this very short period of time of demand for your product. So, and that could happen, but you need to understand it. You shouldn't just march on.
And you would see it. You would see it on their previous premium and what you're quoting at. So you should be able to really get to the root of, hey, this is why we're growing. It's okay. There's price adequacy here, or we're doing something really different, and it's proven, to work on this. But if you don't understand it, that's a recipe for disaster.
So guys, sorry, I dipped out my internet connection, but Adam, I came back on. I heard you talking about a 59% loss ratio, which is really good. Dylan, though, do you want to tell Adam about those guys in Miami with the 3% loss ratio? Because I feel like it's just better.
I believe it was a 2% loss ratio, but no, we don't.
That's not comp. What line is that?
Commercial auto. Even better.
Commercial auto.
Yeah. These guys.
Doug's making fun of people right now, and I'm trying to reel them in and not get a cease and desist on our show. So
we'll find the Twitter post, or X post. We'll throw it up. Hey Adam, sorry, I know we got back into claims, and again I froze. So I apologize. I wanted to know though, because I think it'd be interesting for others to know. So you're able to get this credit facility, right? Able to get this debt. Where do you think you had to be from a premium perspective, or where were you specifically from a premium perspective? You can't do it on day one, right? You still need to get investors, and probably VC investors or people that know the space well, to get things off the ground. But when can you kind of switch gears and move more towards debt, which I think that's a great model for MGAs that they should be thinking about. When do we stop giving away equity? When do we start taking on debt that's appropriate? And what's kind of our exit trajectory, right? Are we joining another group? How are we thinking about removing ourselves from this business?
So I would say our near-term exit trajectory is not so much an exit as a profitability trajectory. Everything, because of our scale, we've talked to 3 different bankers that do nothing but transactions in MGAs, and every single one has said, if you don't show an EBITDA, this thing ain't selling. So I think that's the laser focus for us is don't be taking on or adding staff that's going to increase expenses. Like, you should be looking at how am I trimming and getting either through growth and covering your costs or through automations, and we're doing both. But like, how do you get to profitability? What put us in the place to take a credit facility? I would say at the scale we took a credit facility at, because I mentioned these guys don't dip down to $2 million credit facilities or $3 million. Like 10 is kind of the low end of what you would see from them. It was probably a minimum of about 10 million ARR and very advantageous cash flow. Now we run a lot closer to 20 million ARR, but I think I remember hearing like if you're kind of below 10 million ARR on the revenue side, it's going to be hard for them to get comfortable giving you're just, I think what they're doing is just like a VC, they're looking at it as I'm giving a loan to a group that's not profitable, and I need some assurance that I'm going to recover my loan. And if you're below 10 million ARR, there's just very few buyers out there. You're not on the radar for M&A.
Yeah. When you say ARR, are you talking GWP, or this is your take on listing GWP?
This is we call our revenue what we take out of the GWP. We never that revenue ain't ours. Like if I was sending me $85 million, I'd be a lot more happy. But that's not our revenue.
I mean, that's a good clip of GWP needed to kind of have that conversation then, right?
Yeah, I mean that's probably depends on your commission rate as an MGA. But you're probably looking at like 50 plus of GWP before you can really. Now, granted, we were looking for a larger credit facility. We were looking for a $10 million credit facility. Now, if you were really lean, there's other players that are down there in the smaller credit facilities where I think it would scale appropriately. So you could do this, at a $4 or $5 million ARR business. But your pool of credit facility providers is going to be less sophisticated, maybe less knowledgeable about insurance, but they're out there for sure.
You're definitely gonna have a higher cost of capital as well. Where at that point, maybe the equity still makes sense. When you're kind of comparing those two.
How did your VCs feel about the choice to go with the credit facility?
Ecstatic.
I would imagine, but
yeah. I mean, no dilution for them.
Yeah.
They have our VCs are very sophisticated. We're very fortunate that the early investors in Kinetic in the device business are, kind of tier one VCs. And they knew, hey, this insurance market has changed a lot. You're amazing, but this could still be really hard from a VC perspective, because they had also sat in when we talked to these bankers. They come to our board meetings. They had heard all this. And so I think when they saw we could avoid having to go out to that market, seeing what the terms would be, and take something that's non-dilutive. And we have plenty of capital to get to profitability now, because we're not very far away. We're about a year and a half away. They were more than happy that I think, God, what did one of them say? Like, default alive is, the best thing we could hear.
Yeah. Interesting. So and maybe just to be clear as well, like this isn't like venture debt. This is a credit facility. Yeah, because I think the danger.
We tried venture debt.
I've heard some really bad stories. I know one specifically, unfortunately, where I think the moment of it, the holders of the venture debt see an opportunity to maybe wind things up if they don't like the direction of the business. They'll call on those conditions and just put companies out.
I'd be interested to know who is holding the venture debt, because what I've seen is these banks don't want to own a company and they're not looking to sell it.
Well, I think but with I don't want to get into specific. I'll chat offline. There was revenue streams there that could basically, that the policies in force and allow them to kind of collect on what they felt needed to be collected, and they were high enough up in the chain where they could force it to happen. And so they did that. I think that's the venture debt perspective, which is different than I think pure debt, right? People who are kind of playing in the credit space.
We found the pure credit space, the non-venture debt stuff, also be way more flexible. These venture debt groups that we went out and tried to do the venture debt in conjunction with this credit facility. And there's just, what I read from it, there's way more regulation around what they can put on their plate in terms of venture debt relative to, you have to have new equity and they have to report these things. And these credit facilities are like the Wild West. They got to do whatever they want. And so it was way more amenable to not having to raise equity and still get the money, that type of stuff.
Yeah, very cool. I have so many questions I know we could go into, but I think the idea of how to capitalize this thing is something that does get brought up a lot, and I think nobody's to say, but I think you've even identified there's a specific set of conditions that need to take place before you can do what Kinetic did. But having those options in mind, I think, is good for people who are, getting going at this point. I assume it's okay for maybe people to reach out to you on LinkedIn, ask some good questions, maybe even get some contacts.
I'm great at giving bad advice.
Remind me, it's I can't remember what specifically you said on LinkedIn, but it was a little bit. You were kind of trying to poke some things, or maybe you're just venting. I don't remember, but it was MGA should not be raising venture capital. It was something along those lines, right?
Yeah, I don't think the majority venture capital is a certain return profile, right? If you talk to most real VCs, they're looking for it depends on the size of their fund, but I would say, a 10x return is kind of the standard. Hey, we make a lot of bets and we've got to get 10x, here. And then on some, we talked to funds early on that were like, hey, we still see this being 10x, but that doesn't return our $2 billion fund, so we can't, invest. But if we just focus on the 10x idea, I have a very hard time believing that MGAs as a business model can really get those returns, to be honest. I mean, very early on. So I think there's still, like, if I ever started an MGA from scratch, I'd probably still go to the VC community. There's a case to be made of like, hey, if we do, 5 on 15 here, I think 10x is doable. But the second you get into, an MGA being valued at north of $500 million, like, the rarity of an MGA being sold for more than 500 million, like, I don't know. I don't know the stats, but I can't imagine there's more than like, a handful in the last, 5 years of booming business of MGAs that have been sold for more than 500 million. So I just can't wrap my head around that.
The transaction you were talking about, Peter, that was $3 billion. So that's only 6 times more. And that's a massive insurance company.
Yeah, we were talking about Aspen being purchased by Sompo at the start of this call, but the interesting thing there, Aspen, a long-established Lloyd's syndicate company, publicly traded. I believe they went public this year as well. So to get to that level, that's, I don't know how many years of a company existence, and with all the capital they had traditionally behind them. So I think, Adam, what we'll have to do is possibly have a part 2 to this, because we have a lot of questions, I'm sure, for you on distribution. The growth story to 25 million in itself is pretty incredible. And now you're up to 85. So we've kind of focused very much on the financing this call, which is fascinating. And I do have one final question for you on that. So as well as the instruments, and let's forget about the instrument, be it credit, debt, venture capital, or whatever. The thing that I always find interesting is, how do you decide as an organization what the right amount of money to raise is? And what was your logic there?
I'm the CEO and unfortunately the CFO of the business, so I, daily have a financial model that I look at that kind of takes us, all of our expenses out through profitability. And all I did was, put in the lowest amount of money that would get us to profitability with a cushion in our bank account. I kind of just looked and said, all right, if we've got, 2 million in our bank account as the low point, like, I could live with that. And I just put the lowest amount that would let us do it, and played with some sensitivities of, well, if our growth slows down, or if we do this, or, we don't get this, and basically just found the lowest amount possible, which is probably like the antithesis of venture capital raising, because that's like, I want to do this on the least amount of money possible.
Yeah.
That resonates a lot. Yeah.
It's a great exercise. Peter, I think we got some legacy questions. So Adam, if you've watched the show before, Peter does this great job of kind of, what do you want to do? And I think it's a good time to get into that.
Yeah, you've already achieved so much, Adam. But I think the question is always for our guests, what would you like your legacy to be in this insurance space?
The home run for myself, and I think the Kinetic story is, one, get to profitability. That, to me, coming from the startup space, I always tell anybody starting a company, the best founders don't need to raise money. Any money. You have a product that has strong product market fit. You have people that are willing to pay for that out of the gate, and you're profitable. Like, you're in control of your own destiny. And I think if you look at all these like super successful entrepreneurs, a lot of them have that background. If you're not as good, like myself or others, then getting to profitability is a big one. And I think we're close and on the right track to that, and now have this credit facility to help reach that. And then legacy, I do love this idea of managing every claim as if a senior adjuster were on it and handling it perfectly. because the economics of where insurance has gone is like, that just doesn't work these days. I don't know what it is in other lines, but in comp, these adjusters are handling 100 to 250 case files at a time. So there's tons of stuff falling through the gaps. And software has really, and especially AI, has made it really possible to plug those gaps much more efficiently. So I would love, down the road, if Kinetic continues growing, we reach profitability, and we're acquired by a strategic partner, not a financial partner, not, just another, hey, we're going to bolt this MGA on and take the cash flow out of it, but a strategic partner with a huge comp book that says, we're going to use this technology on all of our claims. That's really the home run for us, and what I would love to see, because it really validates kind of not just our system, but just the general idea of like claims oversight across the whole book.
Nice. Guys, we can end this series of the show. This is going to be gone. This is the last Agent MGA show ever. We had a legacy answer that involved claims. I'm retiring. I'm out. So thank you so much, Adam. We really appreciate your time.
Yeah, of course.
Dylan, what I was hoping was one of the strategic partners are listening right now. They call Adam, and Adam's like, guys, what do you need? 2%, 3% of this transaction? I'm like, 1 is fine. 1% is fine.
It's fine.
Yeah.
I think Markel's going to buy you up. The like first comp product. I think that's a great partner to purchase you.
Yeah, and maybe when I come back, I'll tell you, in a year that we've got a 2% loss ratio.
Oh,
yeah. That's something that's Dylan. That's what I want somebody's legacy answer to be. Is I'm going after that 2% loss ratio. We need to get those guys on the show and see how things are going right now, because maybe it's 1% now. Could be 1%.
I mean, we've got a 0 on one policy. So maybe that's what they're doing.
I love it. Adam, hey man, we all appreciate you coming on, sharing a bit more about the story, especially the financing stuff, because I think it's so important for people to think about the long-term implications of it. Absolutely, would love to have you back on. I think you'd fit well into our MGA, our Age of the MGA After Hours show. Where are you based out of? Where you live?
The company's based out of New York, but I actually live in Mexico City.
Oh, nice. All right.
Hey,
well,
I'll be there in November. We need to get together.
Oh, for sure. Yeah, let me know.
Yeah, maybe we should go record an episode, live episode in Mexico City. I like that idea. So, cool. Well, hey Adam, thank you so much for your time. Keep watching the story, and you guys keep moving on.
No, great show. I really enjoy listening to it. The depth you guys go to compared to other stuff out there, particular in the sector, is just phenomenal. So keep up the good work.
It's amazing because we're all shallow people. The fact that all right. Hey, Adam. Have a good
Thank you, Adam.
All right. Take care.
Thanks.
Take care.
Bye.
I like that guy. I like him a lot. Other than he's not willing to go for a 2% loss ratio, but other than that, really good guy.
Yeah, that's because he has a brain. He knows that he shouldn't be shooting for a 2% loss ratio. But really impressive, interesting story. Love the fact that we got the aerospace engineer coming to insurance to remind all of us insurance people that we're stupid and we didn't make it in life. So good on him for that.
Don't we know another? Fora Valkyrie? She's an aerospace engineer too, isn't she?
I don't know. I still haven't met her.
There's a few clever people around for sure.
Yeah, making us all look better. I also like. I don't think this is where he was taking it, but he was talking about if you have to raise money, you're not a successful entrepreneur. I am now. Every time a founder posts a LinkedIn post about how much they raise, I just be like, not impressed. You should do this.
Yeah. Adam says you're a terrible entrepreneur.
Yeah. I'm gonna tag Adam and let them know that they could be doing better.
He thinks less of you now.
Yeah.
What do you guys think the headline is from this then? For me, it's basically anything past seed stage, if I can get my words out, investment in MGAs is a difficult proposition, right? Can you see that?
I think it's tough. Well, I think this overall for insurance, not just MGAs, but I was trying. I think we've talked about this before. Trying to think of the last massive, like a true $1 billion exit in the insurtech space, whatever you want to call insurtech, MGAs, vendors, policy admin systems, whatever. I think it's Guidewire, and that was a while ago, right? That was an IPO. There hasn't been a massive acquisition like there is in the fintech space, and so I think anybody that's raising a ton of money as an insurtech at a high valuation, anything over like 100 million, I don't know where it's going. Like, what are you expecting to do with this? I don't know.
Well, I'd like to see more lifestyle businesses. I'd like to see a lot of people who are doing this more like the agencies of old days, right? Where the point isn't an exit, it's to make a super profitable cash flowing business where players stay in it for a long period of time. And they're saying, yes, I'm creating a company that I'll be at for the next 20 years. And there's certainly a path to an exit at the end of this, but I want to enjoy the cash flow from this instead. Yeah. I think that's where we need to get to, and we need to lower the costs associated with starting MGAs so that we don't have to raise as much money, or we can do it on, again, credit, but smaller amounts of credit, not $5-10 million, and have $50 million in gross written premium.
There's three really good companies helping lower the cost of starting an MGA. I believe their names are Typin, Loro, and Turris. So I don't know. Is that our plug? Is that our plug for the show?
That's one of the rare plugs. Yeah.
I want to do it's a softball. You set me up for it.
Yeah. Well, that's how it goes. All right. I know you got to go.
I got to go. I got a meeting. Yeah.
Great talk today.
Listen,
very good. Enjoyed that one.
Second part of the season, I feel like listen, the first 5 minutes, whoever's watching, hopefully you just skipped over and got to the good stuff, because that was awful. Yeah.
Are you still in our showers?
Yeah. Let's elevate the conversation for the next one, shall we?
Sounds great.
All right, guys. Have a good one.
All right.
Thanks. You too.
Take care. Bye.